guys, welcome to my YouTube channel. In today's video we'll be talking about candlestick pattern. But before we may proceed, what is a candlestick? A candlestick is a visual representation of what is currently going into the market and which gives us valuable information about the open, close, high and low of a market. So candlestick pattern can be used in combination with support and resistance, downtrend, supply, trend lines, and moving averages. So, for example, if a market, or let's say a candlestick open and closes below the open, we say that is a bearish candle. And if a market open and close above the open price, we say it is a bullish candle. So, but for now, um, you have to differentiate between the two candles because there are two candlesticks, that is a bullish candle and a bearish candle. So the white color will be used for bullish candles, while any color apart from white will be used to represent bearish candles. So but you need to know this before you consider a candlestick. Always take into account its location, whether it is in an uptrend, downtrend, sideways, or a drop, rally, or at the beginning or ending of a trend. So, for real, what does candlestick tell us about? It tells us about the strength of the market, a potential reversal, a retracement, sentiment. Or it also tells us about the entry and exit. So let's start with a bullish candles, a bullish candlestick. A bullish candlestick, as you can see, is a crash representation of a bullish candlestick. We have the open where the market start, the open of the market where the market started, and then the closing of the market. We have the high, that is the highest point the candlestick went, and we have the low, that is the lowest point the market go. That is, and this week, this week from here to here is called the lower week, while from here to here is called the upper week. And this box, like this one, is called the ray body. That is where most of the trading section took place. Yes, let's dive to the bearish candlestick. The bearish candlestick, we have the close, we have the open where the market open, and then we have the close. We have the ray body, we have the low, we have the high, we have the upper wick and the lower wick. Now let's go to candlestick patterns. You have to know that candlestick patterns can either be of one candlestick, two candlestick, or three candlesticks. Patterns with three candlesticks are considered strongest, followed by two candles, and lastly one candlestick. Now let's move to engulfing pattern. What, as the name stands, engulfing shows that something needs to engulf the other. So engulfing pattern, for the engulfing pattern, we have a bullish engulfing pattern and a bearish engulfing pattern. For a bullish engulfing pattern, the first pattern must be a bearish pattern, like a bearish candlestick. Then the second one being a bullish candlestick, and that second one must engulf the first one. That is, the second one must close above the first one. And then what, when you meet such a pattern in the market, what does it tell us? If you meet this pattern, this type of pattern at the end of a downtrend, it shows a potential reversal, because it shows how the market was going down, that the sellers were in control of the market. Then at a certain point now, they started losing their trend, and then buyers are coming into the market. That is why buyers are engulfing the sellers. So when you see it at the end of a downtrend, or at a support level or its demand, it shows a potential reversal. That is, the market is about changing its direction. Okay, that's it. Let's move to bearish engulfing. Bearish engulfing means the first pattern, that is the first candlestick, must be a bullish candle, while the second one being a bearish. So when you meet such a pattern in the market, what does it mean? It means market was on an uptrend. Yes, buyers were in control of the market. At a certain point now, buyers started losing control, and then sellers jump in. Then sellers jump in, engulfing buyers. So if you meet such a pattern at the end of an uptrend, it shows a potential reversal, or at the resistance level, it shows a potential reversal. Okay, okay. Now let's move to the next candlestick pattern. We have doji candlestick pattern. A doji candlestick pattern. A doji candlestick pattern indicates indecision in the market. That is when you see such a pattern in the market. It means neither buyers nor sellers are in control of the market. Okay, this is how to. This is the class representation of a doji candlestick pattern. As you can see, the open and the close are at the same level. That is, the market open and closes at the same level. So the market is indecisive at this point. So there are two types of doji candlestick pattern. You have the dragonfly doji and the gravestone doji. The gravestone doji, um, for the gravestone doji, um, sorry, the gravestone doji. Now, for the dragonfly doji is a bullish doji candlestick pattern. That is, as the name stands, dragonfly. You know, dragon they fly up. So when you meet such a pattern at the end um, of a downtrend, like it at the end of a downtrend, or at a support level, yeah, or demand, or at a demand zone, it shows a potential reversal. It shows the market is about, like, buyers are already in control of the market, because looking at looking it shows that sellers try pushing the market downward, but before the session end, buyers jump into the market and closes the market above the open. All right, now let's move to the bearish version of the doji pattern. The bearish version is the gravestone doji. As the name stands, grave, something that is going down. So when you meet such a pattern in an uptrend in the market, what does it mean? So if you meet such a pattern in an at the end of an uptrend, it signifies a potential reversal. Yes, it's a potential reversal, because looking at it, buyers were in control of the market, but before the session could end, sellers jumped into the market and closed the market below the open. Okay, now let's use candlestick. Okay, the next candlestick pattern will be the hammer candlestick pattern. This is a crash representation of a hammer candlestick pattern. So you need to know, for a hammer candlestick pattern, the longer the week, the stronger the pattern. Take for instance, if you what the psychology behind its formation shows, the sellers were in control of the market, yes, but before the session could end, buyer jumped into the market and closed the market above the open. So when you meet such a pattern um a downtrend, it signifies a potential reversal, yes, or at a support or demand zone, signifies a potential reversal. So but take note, when you meet such a pattern, a hammer pattern at the end of an uptrend, it shows a false uh it may be a breakout. Yes, don't always consider it. So now um let's move to the next pattern, shooting star. Shooting star is the bearish version of hammer. So when you meet such a pattern at the end of an uptrend, it shows a potential reversal, a potential reversal. Or when you meet it in the middle of a downtrend, it shows a trend continuation, because it shows that buyers try to enter the market, but um, sellers jump into the market and then closes the session below the open. So please, you guys, do not always take these candlestick patterns alone. So it's always good to join them with things like supply and demand resistance, trend lines, moving averages. All right, let's move to the next candlestick pattern. Okay, guys, the next candlestick pattern will be the morning star. The morning star, the morning star is a bullish candlestick pattern. It's a bullish pattern. So and it's made up of three different candlesticks. The first candle is a bearish candle. The second can either be a bearish or a bullish, and then the third must be a bullish candlestick. Yes. Take note that this candle can either be um, a doji candle, a hammer, or a shooting star. Yes. All right. What's the psychology behind formation? Okay, as you can see, sellers were in control of the market at a certain point. Before the market, sellers were in control of the market. Yes. Then for the second candlestick, sellers were still in control of the market, but at a certain point, buyers entered into the market. Then it closes as indecisive. So nobody was in control of the market at this point. But for the other trading session, buyers jump into the market and closes the market um, higher than its open. That is, it engulfed the second candle and the third candle as well. So before you consider a pattern as a morning star, it must engulf the second pattern and the first candle. So it must not always engulf the first candle. It can end like midway the first candle. And again, to know whether it's a stronger morning star, there must always be some gaps. There are always some gaps within these two within the candles. There are always gaps. Okay, so guys, when you meet such a pattern at the end of a downtrend, it shows a potential reversal. It shows the market is about reversing. Yes. Or when you meet it around the like the 75%, the 71%, 65%, 50% Fibonacci level, it shows a potential reversal. All right, guys. Now let's move to the evening star. The evening star um is a bearish version of a morning star. For the evening star, you can see the first candle must always be a bullish candle. The second can either be a bearish or a bullish. Then the third candle must always be a bearish. Then that third candle must always engulf the first and the second candle, or the first and the second candle, or it engulf just the second candle and end midway the first candle. So when you see such a candlestick, um, such a candlestick pattern at the end of an uptrend, it shows a potential reversal. It shows sellers are losing their powers to it shows buyers are losing their powers and sellers are jumping into the market. But do not always take their trade the confirmation of just with just candlestick confirmation. You need other confirmation before you can take you can consider it. All right, now let's move to the next candlestick pattern. Okay, guys, the next candlestick pattern is the Harami pattern. What does Harami mean? Harami means pregnant. Harami is a Japanese word, so Harami means pregnant. Take for instance, if a woman is pregnant for a baby, like for a baby boy, it shows that the woman will obviously give birth to a baby boy. All right, for the Harami pattern, for the Harami pattern, there you have two. You have the bullish Harami and the bearish Harami. The bullish Harami is made up of two candles. Uh, the mother and the baby. So as you can see, the mother is pregnant for the baby, and the baby is a white candle. It shows that obviously she will give birth to white candlestick. So such a candlestick is a bullish version of it's a bullish Harami. So when you meet such a market at the end of a downtrend or at the end of a reversal, at the end of a retracement, it shows a potential uh when you meet such a pattern at the end of a downtrend, it shows a potential reversal. And when you meet such a pattern around at the end of a retracement, when you meet such a market at the level of a retracement, it shows the retracement is about to end, and then the trend is about to continue its way. So this pattern is a reversal pattern. Then let's now move to the bearish Harami. The bearish Harami is the bearish is the opposite of bullish Harami. That is, it's still made up of two candles. We have the mother and the baby. So when you meet such a pattern at the end of an uptrend, it shows a potential reversal or the midway, like the mid of a downtrend. It shows a trend continuation, because when you meet such a pattern, the midway, it shows as the market was going down, buyers like tried entering the market, but at a certain point the woman they became pregnant with a bearish candle, so obviously they'll give birth to bearish like to bearish candlestick. Now let's move to the next candlestick pattern. Okay guys, the next candlestick pattern will be the tweezer top. The tweezer top is a candlestick pattern like the tweezer top. When you how do we represent a tweezer top? A tweezer top is represented like this. That is, it's made up of two candlestick, a bullish candlestick and a bearish candlestick. For a tweezer top, when you meet such a pattern, when you meet such a pattern at the end of an uptrend, at the end of an uptrend, it shows a potential reversal. It shows the market is about reversing. Yes, because the market buyers were in control of the market, and at a certain point sellers jump into the market. Then again, when you meet such a market midway, like in the middle of a trend, like um, in the middle of a downtrend, it shows a trend continuation. Now let's move to the tweezer button. The tweezer button is the reversal, like uh, is a bullish version of the tweezer top. As you can see, it's still made up of two candlesticks. That is the bearish candlestick and the bullish candlestick. So the psychology, like the psychology behind its formation is the same as the tweezer top. All right, now that is when you meet such a pattern, like at the end of a downtrend, it shows a potential reversal. It shows sellers are losing their trend and buyers are jumping into the market. Now let's move to the next candlestick pattern. Okay guys, the next candlestick pattern is the three white soldiers. Three white soldiers, they are made up of three candlestick patterns, all bullish candles. So when you meet such a candle, like at the end of a downtrend, it shows a potential reversal. A strong reversal. It shows that the market is about reversing. Like the market is about that is sellers are losing their trend to buyers. So and again, when you meet such a trend, such a pattern in the middle of an uptrend, it shows a continuation pattern. Shows that buyers are still in control of the market, so the market will continue going up to a certain level. So guys, let's move to the next candle. That is, this is the bullish version. Now let's move to the bearish version. The bearish version is the three black soldiers. three black soldiers. Three black soldiers. Alright, like I said, the three black soldiers is the very version of the three white soldiers. When you make such a pattern, like such a pattern, the middle of an let's say at the end of a downtrend, or at the end of sorry at the end of an uptrend, it shows a trend reversal. It shows buyers are losing their trend to sellers. And when you meet such a pattern in the middle of a downtrend, it shows a trend continuation. So this pattern uh, can either be a reversal pattern or a continuation pattern. So take note, when you meet such a pattern, when the pattern, like when the candlestick are without width, when they don't have width, like the upper wick and the lower wick, when they are not having the width, it means they are the strongest. Yes, they are considered to be the strongest. Now let's move to the next candlestick pattern. Alright guys, the next candlestick pattern will be the spinning top. The spinning top, they are effective in a trending market, mostly at the end of a trend, and it can either be a bearish or a bullish signal. So you need to know that the longer the wick, the stronger uh, the pattern. Okay guys, I hope you guys were taking notes. Like if you are not taking note, please watch the video and then you take notes. And again, I hope you guys like love the video. Please, if you really enjoy the video, please make sure you like, subscribe, like and share. All right guys, see you in the next video.